It's 1:07 p.m. on a Tuesday. The S&P 500 is humming along, billions of dollars are flowing through the fiber optic cables buried under New York City, and you're probably thinking about lunch. Maybe debating if you should DoorDash again, even though you promised yourself you wouldn't. Then, the Associated Press sends out a tweet. 2 sentences, 116 characters. It says there's been 2 explosions at the White House and Barack Obama is injured. In the next 3 minutes, $136 billion of American wealth simply vanishes. It wasn't a market crash caused by a bank failure or a housing bubble. It was a glitch in the human collective, triggered by a single line of text. If you have a 401k, a Roth IRA, or even just a few shares of an index fund, you need to understand exactly how this happened. Because the terrifying thing isn't that a Twitter account got hacked. The terrifying thing is that the system we trust with our life savings is now so fast and so automated that it no longer needs humans to hit the self-destruct button. It'll gladly do that all by itself, thank you very much. To understand how one tweet can delete the equivalent of the GDP of a small country in seconds, you have to realize that the stock market isn't a room full of guys in suits screaming at each other anymore. The modern market is a dark forest of algorithms. These are high-frequency trading bots, or HFTs. They live in server farms located as physically close to the stock exchange as possible because they need to trade in microseconds, millionths of a second. These bots are programmed to scan everything. They don't just look at price charts. They scan news feeds, headlines, and yes, social media. They are looking for sentiment. If the news is good, they buy before a human can blink. If the news is bad, they sell before the human brain can even process the first word of the headline, or finish sipping their iced coffee. So, back to April 23rd, 2013. The AP's Twitter account is hijacked by a group calling themselves the Syrian Electronic Army. They send the tweet. Breaking, 2 explosions in the White House and Barack Obama is injured. Now, a human reading that might pause. They might notice the phrasing is a bit off. They might check a second source. They might even refresh Twitter like 5 times just to be sure. But the algorithms don't have a pause function. They don't have intuition. They see the words explosion, White House, and injured. Within milliseconds, the sell orders start hitting the tape. The Dow Jones Industrial Average plunged 143 points in seconds. It looks like a cliff on the chart, a straight vertical line down into the abyss. This is what's known as a flash crash, and this is where the personal finance aspect gets unsettling. Most people think their investments are safe because they're long-term, but these crashes prove that the floor beneath your feet is much thinner than you think, more like a trapdoor with Wi-Fi. When the bots start selling, they trigger other bots to sell. It's a digital stampede. The liquidity, the actual money available to buy stocks, simply dries up because the machines are programmed to step back when things get too volatile. For those 3 minutes, if you had tried to sell your stocks, you might have gotten pennies on the dollar. If you had a stop-loss order set, a tool many retail investors use to protect themselves, your broker might have automatically sold your positions at the very bottom of that $136 billion hole. You would have been wiped out by a lie, and by the time the AP regained control of their account and sent out a correction, your money would be gone, and the market would have already bounced back to where it started, like nothing ever happened. And you'll be left there in shock, feeling dumb and confused, just like how your emotionally unavailable situationship made you feel after leaving first thing in the morning. Think about the psychological toll of that. Imagine checking your retirement account during those 3 minutes. You see your life savings down 10%, 15%, 20% for no apparent reason. You check the news. You see a tweet about an explosion. You panic. You hit sell. And just as your order executes, the AP deletes the tweet. The market snaps back like a rubber band. You just paid a panic tax of tens of thousands of dollars to an algorithm that doesn't even know your name. Or care, frankly. We like to think of the economy as this rational, grounded entity based on earnings reports and GDP growth. But in reality, it's a psychological construct being managed by machines that are trained to be paranoid. The vulnerability isn't just in the code, it's in the speed. We have built a financial system that moves faster than human accountability. By the time a human regulator at the SEC even saw the tweet, the damage was already done and corrected, probably while they were still opening the email alert. This brings us to a hard truth about your money in the 2020s. We are living in an era of weaponized information. If a hacker group could do this in 2013 with a simple password phish, imagine what happens in the age of AI-generated deepfakes and sophisticated bot farms. We've already seen glimpses of it. The 2013 Twitter crash lasted exactly 3 minutes. In the grand scheme of a 30-year retirement plan, 3 minutes is nothing. But for the people who panicked, for the people whose automated systems failed them, those 3 minutes were everything. We live in a world where a single person with the right password can briefly break the global economy. It's a fragile, strange, and slightly terrifying reality. The systems we've built to create wealth are the same systems that can delete it in a heartbeat, faster than you can decide what to eat for lunch. So yeah, the market didn't crash because of war or recession or a housing collapse. It crashed because of 116 characters on a hacked account. And if you want more breakdowns on the hidden, uncomfortable truths behind money, investing, and the systems we trust way too much, don't forget to subscribe. See you in the next one.